actually know. Like, what if I just didn't have it? Oh, fuck, if I didn't want to just give it, I would have to give it. You know, I hate when people put me like spots like this. I really hate that shit. I ain't gonna lie, I hate it. Like, I really hate it. Like, don't count my money. So, like, don't do that. I hate when people not count my money. Don't get one. I hate when people do that. Push you on. Shut up. I hate that shit. That shit pisses me off.
Hello guys, how are you?
How you doing?
Hey, you can hear us?
How are you guys doing?
All right, how you doing today?
Oh, hold on. I think I muted my computer. Okay.
Can you hear us?
I can hear you now, yeah. That's usually how I know I've muted my computer. All right. So how was your trading week? Getting better?
This week actually been pretty good. I mean, the market been real green the last couple of days.
Yeah.
Well, I thought it would have been this good this week.
Yeah, well, definitely. I mean, the SPY gained 9%. You can't really be upset about that. That's a amazing move. And the Apple and Amazon, I swung some Amazon and some Apple this week as well, and now flipped my position. So we will get into options. I know you've been dabbling in them, so this might help you guys with that as well. Just breaking it down so that you will really understand the ins and outs of it. And then on Tuesday, we'll go over the Greeks as well and a little bit more into different option strategies. So this one's the basics, like we went over a stock before. As always, the legal disclaimer that this is for educational purposes. All ideas and strategies should be tested before going forward with them. No past performance is indicative of future performance, and there are varying degrees of risk in all securities instruments. And as you know, with options, there are risks, right? If it's not going your way, you will definitely see a downfall if you have bought that option. So an option is really a trading instrument that is a contract. This is actually, you're buying a legal contract for you to buy or sell a stock at the later date. Now, just like a stock where you can buy a stock or you could short a stock, you can also short an option by selling the option. And I'll go over that a little bit further. So it's going to give you the right at a certain date to be able to buy or sell that stock. And then you have that specific price, the strike price. And this option is good until that expiration date. So as we went over the futures contracts as well, it's the same thing. So futures contracts are very similar to options. However, they trade solely based on a commodity. Options trades around an underlying stock. So you can't say buy an Apple call and then say, oh no, I'm gonna replace that with Google. It doesn't work. It's only for that particular underlying stock. Does that make sense to you guys? Okay. Now, another way to view it is, whoops, hold on. Okay, so say you're selling your house, right? And the market value of the house is $250,000 today, or you want to sell your car, roughly $50,000, right? Well, I'm coming along, I'm the buyer, and I'm willing to give you a contract that says I will buy your house for $250,000 in 3 months, and I'm going to pay you $5,000 today to lock in that price for 3 months from now. Or I could do it with the car too. I'm going to buy your car for $50,000 in 3 months, and I'm going to pay you $1,000 today. That's my assurance that I'm going to follow through with that contract. But I can back out no matter what, right? So right now, you would get $5,000 And then in 3 months, guaranteed 250,000 if I follow through with a contract, or 1,000 for the car and guaranteed 50,000 in 3 months. Would you guys take the offer?
Yes.
Yeah? How about you, Cleveland? Would you take the offer?
No.
No? Why not? I'm just curious.
I think it might be no, though.
Well, can you say the question again?
I think he missed something. That's my thing. I said no.
What'd you say?
Can you repeat the question?
Yeah, would you take the offer of me giving you the money right now with the option for me to buy it in 3 months? Like you're locked in for 3 months to sell it to me at that price of 250 for the house or 50,000 for the car. Would you lock yourself into the contract?
No. Something could happen too to the house.
Yeah, but what if okay, so no.
I said no because what if something happens to the house that bring the value down?
No?
No.
All right. So if you were to take the contract, then the price goes up, you would lose, right? Because you're locked into that 250,000. So I would be the person making the gain of $45,000. However, you would lose that opportunity to make the additional 45,000, but you know that you are definitely getting that 250,000 3 months down the road that I'm buying because it's gone up. So I decide to buy. Well, what happens if the house drops down to 200,000? Then I'm the loser because I've put out the $5,000
Oh,
and I could still buy the house at 250,000, but there's no guarantee that I'm going to buy it, right? So I'm the person that's out the money in that scenario. So this would be similar to a call, right? If the car went up in value, maybe it's you modified the car, you put some extra stuff on it, and it goes up in value, or it's extra desirable, then I make an extra 9,000 and you would lose that 9,000 opportunity. But you're locked in. You've already locked in that extra $1,000, so that's not an issue. And if it drops, I'm the one that loses, right? So better depiction of a call option, right? It makes more sense for you guys. Kind of what happened with AMD, right? There wasn't a guarantee that it was going to go up, so you're out the money that you put for the option. That's it. You're not out anything greater. That's it. So again, the option is a contract for the right to buy the stock at a certain price, or the put is to sell the stock at a certain price, right? And you are going to go out and buy it with a direction because you believe that it's going to continue in that direction. Now, as with a stock transaction, there's always somebody on the other side of that option. So there's a buyer. Many times we're the buyers. The writers are the people that write the options in the opposite direction, right? So if I'm buying a call from you, Kyle, and say it's to buy Apple at $115, then you are obligated, if I were to exercise that option, to sell it to me at $115. So no matter what, any time between today when I buy the option and the date of expiration, I could call you and say, hey, I'm going to buy that from you. Okay. It might be at 113 and I'm still buying it from you at 115, or it could be up at 120 and I buy it from you at 115. So the seller has the obligation to fulfill the stock, right? That physical asset. Does that make sense to you guys?
Yeah.
It's kind of like shorting the stock. You have to physically repay it back to the broker because you borrowed it from the broker. Well, you have to repay it. So in the put scenario, when you buy a put, you are buying the option or the right to sell the physical stock at that price. So for example, we have Apple that's trading at 118.38. Well, maybe I have a 120 put. I can exercise that put as long as there's enough capital in the account, and I can sell those shares today. Now it's going to require more capital, but I could exercise that option today. If it was expiring today, if it's expiring in 2 months from today, I have any right to exercise the option or call the shares from that writer of the option, and the price at which the writer is obligated is the strike price. All right. So you also want to be aware that if you're close to being in the money, then you have that ability where they might, if it's the day that it's the day of expiration, they might exercise the option for you, your broker as well. Yeah, so you have to be aware of that. If you are in the money, well, we'll talk about it on the next slide. So we have the different strike prices, right? For this one, it's $5 increments. $90, $95, $100, $105, $100. So say we're in a call option here at $95. Our strike price is $95, the blue dot. And we're in the money, if it's at $100, $5. Anything above where the stock is trading is going to be out of the money. Anything above $95 for us is in the money. Anything below $95 for our option is out of the money. Does that make sense to you?
Are you doing like a slide right now? Do you have like a PowerPoint up?
Yeah. Did I not show you my PowerPoint at all? Hold on. Hold on. Did I not share my screen? There you go.
All right.
So here, we'll go back a little bit. We'll give you the visuals that go along with it. So the house, buying it, right? And the car. So again, if I were to buy the house, then I make the 45 and you lose the 45. Or the house drops in value, I'm the one that's out. Oh, I'm sorry, guys, I didn't give you the visuals. Then same thing with the car. If the price rises to 60, then I'm the one in the profit of the 9,000 because I paid that $1,000 for that contract for 3 months. So that's the time that I've paid for, is that $1,000. And then if it drops to 40,000, I have no obligation to buy it from you, but I'm out the $1,000. All right, so here we go. This is the visual of the buyer has the right to buy the stock at a certain price, and the seller is the writer of the option. They have the obligation to fulfill the contract. They're the other person on the side of that contract. So if you two were selling something between each other and you wrote a contract down, you said, hey, you know, Cleveland, I'm going to buy your car for, I don't know, $15,000 in 2 weeks, and I'm going to pay you $20 now for it. Then you have that right locked in for 2 weeks. So it's an actual physical contract that you are buying. It's a tradable instrument. And go ahead.
Like a deposit?
It's kind of like a deposit. The premium, what you're paying is you're paying for time. We'll go over it. It's coming up. But it's locking yourself into a contract for a certain amount of time, and you have that right to go forward with the contract or not. All right, there's the visual. Now it makes more sense, right? Now you see what I'm talking about, the $5 strike prices. So we have a in the money call. Right now it's in the money because the stock is trading at $100, right? And anything above 95, which is where our call option is in the money as well for us. But anything below, anything above 100 is out of the money. Okay? So this is where the price is trading. For this example, it comes up at 62. All right, so this is at the money. This is the price at which the stock is trading. Yeah.
All right, it's for in the money, at the money, and out of the money. Okay, so like which one do we make the most gains on if okay, so like if we buy a call, let's say we buy a $50 Apple call. Let's say that, yeah, if Apple was $50 and we wanted to get a $50 call, but the current price was $49.50.
Right.
Is that too close to the actual strike price to like would that be considered at the money?
No, it would not be considered at the money. So let me draw on here. All right, so we have, we'll say Apple, and we'll just call it $100, for example. So Apple's trading here at $100, right?
Yeah.
That would be at the money. Anything that's at the current price is at the money.
But I see that they do it sometimes whenever it's close. Like it might be close to the actual price.
Yeah, exactly. Because sometimes, so maybe we have 102.50 calls.
Yeah.
Right? They're not exactly a penny. And maybe it moves up to 101. So it'll still show at the money here, but maybe it'll show in at the money on the put side, for example. Because it's in between the two strike prices, sometimes they'll move the at the money up or down, whether it's closer to one of those strike prices. Does that make sense for you?
Yeah, but out of those, like let's say we bought we bought a call that was out of the money, at the money, and in the money at the same time.
Here.
Which one would make better gains if if it's a call that we did?
Yeah, for sure. So we'll look here. I'll pull up the can you guys see this?
Huh?
Okay, perfect. So right now we're looking at Bank of America, for example. This is November 26th, or excuse me, 6th. So we'll look at next week, for example. Now, when you are trading, I'm going to put this one to be Delta, and we'll cover it a bit more. But Delta will really show you how much you're going to make for that option if the price of the underlying instrument moves $1. All right, so I'm going to increase it to more strikes as well so you guys can see it a little bit more. So you can see the further that you go, this is in the money, right? Right here. Anything gray on this one is in the money. We're at 24.25. So it's in between the two right now, right? It's not 24 exactly, and it's not 24.50. Let's add both of them on, and let's see where they put it on the other side. So the other side, they have it in the money at 24.50 as well. So it's not exact because it's 24.25. It's right in between the middle. So when you're looking at it, when you are in the money, you will typically make more money. It will trade as it goes $1, for example, you would gain potentially a penny, right? Because each contract is worth 100 shares, right? So it's a contract for 100 shares of the underlying instrument. Now, for example, maybe we know that Bank of America is going up, right? Maybe we have dark pool activity and we're above those big prints, or you're above the biggest volume, or you've just had a breakout. Let's do it actually with AMD, because we saw AMD break out today, right? And it broke out at $83. So if you had bought it at 83, for example, it might have been 11 cents. And now it's all the way up to $2.80 because it went up $2.83. Does that make sense?
Yeah.
So it might have cost you 10 cents to buy it, but it moved and it gained $2.60, for example. Here, let's look and see. So the low of the day for this call for AMD was 42 cents. So you do have the level 1 as well. And you have the bid and the ask for the option right here. So if you are buying, right, and you know that it's going to go up, if you buy out of the money, the implied volatility increases the closer that it gets to that strike price, right? So let's continue forward and then we'll go back to the chains, all right? Because it'll become I'll be able to play with it a little bit more and we'll go over everything and we'll pull it back up, but we'll cover it for you. All right, so exercising an option. I went over this as well. You have the right to exercise the option to, spelling error, buy or sell the stock at the strike price before the contract expires. So if you had had the AMD option, for example, for today, for next week at $83, you could have exercised it to hold the stock instead of the option. And if the expiration date passes, so maybe you had had an 83 call expiring today, and we see that it's at $85.73. You go, yes, I am up $2.73 on my options. This is great. I'm so excited. I'm going to go out and party. You don't close out the option. Well, you could wake up to Monday morning. You owe your broker the cost of 100 shares at $85.73, or excuse me, $83. 100 shares at $83 because it is a contract. So if you are in a contract in the money, a put or a call, you always want to put in at least a sell on close at market for that final day. If you forget, you could end up waking up to your account with a big negative on your margin because they've exercised the option. Do you guys have a question?
Just what you said just now.
I can barely hear you, Cleveland. Sorry.
Like what you said just now. We was just talking about that, so that was like perfect.
Nice. Timing. Everything happens for a reason. All right. So when you also have the option contracts, you might see in your account, okay, much like a stock, you have the buy or the sell, or you're going to have a negative, right? You might have a +1 if you're long, or if you've by mistakenly sold it, you'll have a -1 in front of it. That would be if you shorted it. So it can happen too, that maybe you hit the wrong button or you hit the wrong box and by mistake you short an option instead of buying it. You'll have that negative in your account. And then you have the number of contracts. And remember, each contract is for the value of 100 shares, right? So if it moves, it would theoretically move at the value of 100 shares. If you had one contract of Amazon moves up $50, that's a $5,000 gain, right? 50 times 100. And then you have your stock symbol right here. The month at which the option expires, and the date. If there's a particular date, if it's not a monthly, you have weeklies, you have monthlies, you have quarterlies, you have on the SPY 3 strikes a week. Some brokers, Thinkorswim even has the same day options for the SPY. You also have the strike price here, and whether it's a call or a put, and then the price at which you pay for it. So sometimes people might put into a chat, okay, Apple March date, strike, call, and a particular price at which they bought or sold it. So that's how you break all of that down. And the contract price, this is that premium. As we were talking about, the premium is what decays over time, right? That's what will sort of melt away. We'll go over it. So back to the option chains. That's why I said we'll get right back to it. So on the option chains, we have our strike prices right in the middle. Then we have the bids. So we have the bids. This side is the calls. Usually it's always calls on the left and puts on the right. And another way you can tell is this area, the shaded area, is our in the money, right? So it makes sense because the puts are expecting it to go down. So it's in the money when we are above the strike price. The calls would be in the money when we're below the current price at which it's trading. Then we have our ask price, and in the middle right here would be the mid price. So you can see Apple, we've got 12.20 and 12.35, 281 and 284. So it's not that big. I mean, this is 15 cents or $15 spread. This is down to 3 cents. This is down to 1 penny, right? So you can also see when you get further in the money, sometimes it will be a bigger spread on the option. We also have the volume right here and right here. So you want to be aware of the volume and also the open interest. Did you have a question, Cleveland?
So it would be better if, so what, like risk management with calls and puts, what would you recommend? So would you get something that's far out, like, or not as close to the money?
There, you have to figure out the sweet spot and also the timing of how far out.
Okay.
And also looking at the chart, you
Right.
have to see what is, all right, with the $90 calls, right, for AMD. That was a bit far out. And I'll show you here, right? I know, just close this, AMD. So you want to look at it. You bought them right here, this day, right?
I think so.
October 26th, I think.
Yeah. Okay.
Yeah.
All right. So even though it's up here and it was at 83, and you're anticipating, okay, potentially a breakout. Well, before we didn't have this downward trend line here. Oh, yeah, we did. We already had this downward trend line. So you might look at it and say, okay, we're right here. I need confirmation that it's breaking out, right? We have earnings coming up automatically right before earnings. The premium that you pay, it goes up. It is like this. So let me come here. So before earnings, the premium's lower. Then, hey, you come up like this. It's like a bell curve for how much you pay. Earnings announcement right here. So maybe 4 days before, and then this is literally the day of, like 1 day after it drops back. So the first day, 4 days out, you might see that the premium, it's not that crazy. They haven't really built in the cost of the potential move yet. And so it's trading at a normal trading price. Then maybe we have 3 days, 2 days, and 1 day. So you can see if you buy it the day before, you're paying a lot more for it. It's like right before, I don't know, trying to think of a good analogy there. But it's people have a higher demand for it as well. And they're anticipating a bigger move because the earnings is coming. And so they'll say, all right, we're going to charge more for it. There's more potential volatility that will happen. Much like when you see the VIX, the VXX, when you start to see that increase, you see the cost increase on both sides. So you'll see the cost increase on the calls and you'll see the cost increase on the puts because the volatility is going up. It's the same thing that happens with earnings right here. So you could potentially buy 3 days, 4 days earlier. And if it was to stay the exact same price and you sell it just before earnings, you make money just based on the volatility going into earnings. I know that doesn't really directly answer your question, Cleveland, on how far out to go, but it's just a lesson on earnings with options because you bought this one with right here. You bought it this day. Yeah, I can draw on here. So you bought it right here, right? And that was 2 days away, right? Or 1 day away, the day before earnings, right? So automatically you were paying more for it. You're paying it at a premium. And probably you saw that it dropped. First of all, it'll drop right that morning of the earnings. The first 15 minutes, boom, the premium starts to disappear. And so you see it come down now. When it goes below over here, well, the next day it really gapped down. You might be thinking, all right, I'm going to wait and see. I'm going to wait and see. But now, whatever you paid for it up here, it's now down. Let's see, how many? 7 points, right? When we go back to looking over here, let's go here. So if it goes down 7 points, you're up here at 90, even, that's this week's. Let's go out, for example. You bought it 2 weeks out, right? Okay, so it's almost back. Well, it's a little bit higher than where you bought it. So maybe it's $1.40, we'll say. But then it drops down and you end up, add some more strikes here. So then instead of it being $1.40, it's like up here. It drops down to 30 cents all the way at the bottom because of the delta. The delta will tell you, hey, every time that you drop down, right here, as it goes further away, oh, we lose 3 cents per dollar. Now we lose another 3 cents per dollar, or 50 cents, excuse me. This is 3 cents per 50 cents because it's 50-cent strikes. So you might look at where is the sweet spot also, where is there super large volume, right? As I mentioned with the slide, we have the volume that will show us this is the volume traded for today on it. It's not overall, it's just today's trading volume. And the open interest is the overall open interest for the stock completely, for that, excuse me, not for the stock, for that option. So anytime from when the option existed to today, this is the open interest. And if we see, like right here, we have 15,000, and this is the open interest up until today, right? We know that there were more contracts that were written today. Same thing here. There are more contracts written at a strike price of 115 and 117. So seeing that, aha, maybe we need to pay attention to this. Why are there more being written right here? And for today, this one didn't have more. This one had more written today at a price of 120 for Apple. Do you see? Does that make sense? You look like you're a little cloudy on that, Kyle.
And so that's how they come up with the unusual options.
Yeah, now sometimes if you see unusual options, let's see if I have any. Unusual options actions today. Let's see if I can find any that's like super easy to see. So for stocks, we'll look at the most unusual options. It's pulling it up. So Ford had a crazy. So sometimes, now there's no guarantee, right? This is Ford and it is for, let's see, December 24th, it says. So let's go down here. We want further out, December 24th. All right. So you'll see, all right, look right here. This is kind of interesting. Why were there 40,000 contracts written at $7 when we're trading at $7.76 right now? Does somebody know something?
And those puts.
Those are puts, yeah. So why are people buying puts at $7? But here's something that you also have to remember, is that really big hedge funds can use options to protect themselves. So say they bought 400,000 shares,
Right.
or 4 million shares of Ford today. This is their insurance policy. If it were to drop down, all right, well, you know what? We're going to make money on the downside. These cost 23 cents. So we're willing to pay 100,000 in insurance on the options to protect our position should it go down.
Way to straddle it.
Yeah. But there's nothing over here. So it's, hey, this is where our stock is. If it goes down from here, we want to protect it. And they gave themselves 6 weeks for that to happen. Now, let me see if at the same time, did we get any weird prints? 200,000, nothing really crazy today. But nothing that would say, all right, this is definitely going down or anything like that. But I did want to show this to you guys because there's been a lot of activity. Look, what stock is this?
Apple.
Yes. How many shares?
3 million. 5, 7.
Ignore these two. Let me do this. Oh, not that one. Oh, that's actually 93, whatever. Yeah, so we have 3.2, 2.2, 900, 650, 500, 400, 300, 200, 200, 200. So roughly 9.8 million shares were traded on the SPY today. I mean, excuse me, on Apple.
Today?
Today. This is today. Today.
And Apple just released news too about pre-orders of their phone.
Okay, that's probably what it was in relation to. But you see how we see prints and then the news comes out. Where are we in relation? This was at 1761. This was at 1784, 1776, 1826, 1826, 1826, 1761, 1738, 1730, and 1790. For now, we're up above all of these. There was also one at 1903. Now, when we go back and we look, were there any yesterday? Okay, closing, we disregard that. 930, we disregard that. 1 million at 1796. We're above that. 1903, 1819. So we see that there's potential movement before it happens.
Do they have any dark pool prints for Sony?
Nothing yesterday. 70,000 today, but that's not really that big. If we see something like, let's see, let's look at the chart and see if we can find. I have two charts open. Hold on, let me close this one. So maybe this day, let's look at the 28th of October. No, nothing even really on the 28th of October. They had some canceled prints. Here we go, 100, but this is closing price. There was some yesterday, 150, you see that, 3 of them, 87.59, 87.59, 89.6, and then 70 today. So you can see on average, anything above 50 is something to potentially pay attention to for Sony. But other ones, like maybe we had Baba that came out with earnings, right? 66,000 there. Let's see. Usually we have big prints. 140,000 on Baba yesterday at 120 at 125 in the afternoon for 289. And where are we? We're above it. So they were buying yesterday.
What about Microsoft?
Microsoft? Yeah. Microsoft, we had some yesterday. Right here, 500,000, 223.52, 223.29. Oh, those are closing. Hold on, let me do this. Let me sort it to all right. There we go. This way we can see only what's really important. So really the 500,000 at 223.52, which we're almost there right now. We're 223.64. Right. But really the other one is Apple. Because we have this downward, it's almost really ominous because we're right here at the trend line and we have the big gap down below, right? We have the gap from here to here and another gap down here. So are they buying or are they selling? It's too early to tell. Today they just came in, we don't know. They might have said, yeah, we have this great news. However, they also had great news with their earnings report and the stock tanked. And now it's gone back up. It is above here. It could be potentially, like I said before, it could potentially go to up to 148. We'll see. If it goes up from here, then potential targets of 148, you guys could potentially use that as a target. And you will look at it and see the option chains are about to stop. So we'll look as well, Apple. You could look at it and say, all right, that's interesting. We know there's a lot of activity. Why won't my mouse show up? And so we say, all right, we are November 6th. So we want to go out at least 2 weeks. This goes back to your question, Cleveland, of how far out do you want to go? So we'll look out. You don't want to necessarily trade today's because of that decay as well. It decays so quickly, which I'll touch on as well. So you want to go out usually 2 to 3 weeks. You want to give yourself time. Remember, what you're paying for is time when you're paying for that premium.
All right, for that, okay, like let's say you want to day trade it. Does it still matter?
If you want to day trade it, it would still matter. Practice on paper to see if you day trade today's it's going to automatically be decaying, right? So if we look out and we look and we see, okay, well, how far out on the 18th, on the 13th, let's do this. Put this over here and let's put this right here. So we have the chart right next to it. And make this a daily chart. So we can look and see, all right, well, if we think that it's going to go up to 148, how long did it really take for it to go from here to here? Okay, it took 22 bars. It took 3 weeks, right? So maybe we want to be a little bit more conservative because you don't want to go too far out at the same time, like you did with that 90 call. It was a little far out based on the amount that you'd had. So maybe what we want to do, okay, well, we want to see, we know that there's big volume. Potentially, you guys could paper trade this. Potentially, you could strangle it. We don't know the direction yet, right? We know that we had big prints. So you don't go really big until you're confirmed of the move, what direction we're going to go, right? You could test it out and see. So maybe you want to spend, okay, we look at this and we say, all right, well, maybe we come up here, 125.50 might be a resistance point. And this is 1 week away. We want to go out 2 weeks. And maybe you want to give it a little bit of room. So 125. Okay, maybe you want to spend roughly $100. Now look at what happens. If it goes up, that $100, again, it's turning into 50 cents per dollar. So it's going and it's moving from 90 cents up to 300. So it will grow exponentially when you're out of the money if you have the edge of knowing the direction. Does that make sense, Cleveland? Okay. So you can also look. All right. Well, we saw that we had these. It's not moving for me. All right. Whatever. It's not going to move. It's not going to move. So we had these massive prints. Ah, look at this. 125. Look at how many contracts were written today. How many were traded? How many have already been traded there? Let's move this over here. That's what I was trying to do. And how many puts at the same time? How far out? Well, look, they have puts all the way. Where's the biggest open interest? All right, this is something to pay attention to. We also have open interest on the put side at 110. And the biggest open interest on the call side is right here at 125. So you could say, all right, well, maybe I'm going to play it a little bit more conservative. Maybe I'll go a little less expensive. I'll come out $3 more and go to 51. Doesn't mean that you're waiting for it necessarily to get to that price.
Right.
Right? You could have it go to 100% ROI, and then you take half of it off. Guess what? Then you're in a no risk trade. Right? Because if you were to buy it, now it's going up at the end of the day, huh? If you were to buy it at, say, 128 for 50 cents, you buy 2. Well, then it moves up. It gains. How much would this also take? You also want to look at this and say, all right, well, what's our delta here? For this to get up to roughly 50 cents, 50 cents divided by 13 is going to be roughly 4.5, right? Let's see, 0.5 divided by 0.13, 3.8. So it would have to move up $3. And what's the likelihood? What's the likelihood of this moving from 118 to 121? If it's going to move up, if they were buying, it's going to move up more than $3. Right? How much did we move today? Today's range was a low of 116 and a high of 119.20. You had a $3 move today alone. So you can day trade these, and then you can also hold on to it. You could day trade this. You say, all right, I'm going to buy this at 50 cents. I'm going to get my money out, and then I could leave it. until expiration. You see that it comes up, maybe you see that it reverses down, you gets really far away from the 4 exponential moving average. All right, you know what? I'm going to trim my profit here. Great. This might end up being up at 124 on Monday after seeing all these prints. And what's going to happen? A rough estimate, we can say 119. Okay, it's moved up 4, right? So if we'd been at 125, it would be like we're at 121. So our 125s at 93 cents then become $2. Does that make sense to you guys?
Yeah.
So if you'd been up here at 128 and it happens to move up to 124, that would actually be $5 move. So then it's like we're at 123. Then they go and they triple. And you're making 300%. Or you're making 200% because it's a $50 investment. Make sense?
That makes a lot of sense.
Okay. So let's go back. There's still more to cover. So we have the premium decay. You're all excited. This is your AMD. You see it. It's awesome. And it's this ice cube here. And then, it melts away to 0 with the premium because it didn't move in the direction that you wanted it to, right? And next week, we'll talk about spreads and how you can sometimes prevent this from happening by trading a spread. So if you thought that it was going to go up, you could have sold, for example, a 92 call when you bought your 90, and then you limit your risk because you limit your profit to 200. Let's go and look at it.
Yeah, that's something I want to learn about too, like the credit and debit spreads. I never really messed with that one.
Yeah, no, you don't. Well, a debit spread is one that's going to protect you time-wise from premium decay. So say you had gone and you wanted to look at, for example, the 90, and maybe this is what the price was. Well, then you could sell this one. So you're buying, what you do is you buy a 90 and then you sell the 92. So you might be buying it at 137 and you sell it at 90, which is costing you 47 cents, but your potential gain is $200. We'll go over it more. So that even though you have that time to go out, and then you know what happens? So it drops all the way down. Well, guess what? If it's dropped down and you've had, you've gone ahead and you've locked profit, and this upper one, because this upper one will decay as well as the lower one that's closer into the strike price or at the money price, excuse me, that say we're here and it drops down $4, right? Well, if it dropped down $4, then your 91 is now worth 60 cents instead of 34. Let me adjust this window. There we go. So your 91, say it dropped $4, as it did on you. It really happened. So your 90 is now worth 60, and your 92, which was worth 90, they don't have a 98, huh? Or 96. Well, we'll just say it's 30 cents. So you could close out, you could buy back this one for 30 cents, and you made the difference of 60 cents. Do you see that? So even though you pay, now your risk is down to just 30 cents. I'll write it over here. So if it's going to disappear, but if you'd bought the 90 for 134, we'll say, and you sold the 92 at, it was 90 cents, then your cost, this is a plus and this is a negative, right? So then your cost in this example is 44 cents. Does that make sense to you? Okay. So then this one drops down to, what was the pricing again? To look at it. So we go to 94. So then this one goes to 60 cents value in your account, and this one goes to 30 cents, right? So this is a negative in your account. You have negative 92 and plus this one. So you close this out. You spend 30 more cents, right? But you captured the 90 cents to 60 cents because it's short, right? So in closing this out, you gain 60 cents. You gain 60 cents, but you have the cost of buying it back at 30 cents, right? So then your overall cost now for that call is 14 cents. Does that make sense to you?
I need to do a couple more of those though.
Because yeah, well, I'll visually make it clearer for you so you'll understand how it happens. All right, so premium decay, no fun for anybody, right? And so when some people have been really taught to sell options for premium decay, which is not always the best. You could have a couple base hits, right? But it's like shorting a stock. When you are buying an option, whether it's a call or a put, just a directional option, right? You are limited to the cost of that option. If it costs $100, you're only out $100. Well, if you sell an option, it's like shorting a stock. Yeah, there you go. That when you sell the option, the risk is unlimited because theoretically it could go to the moon, right? And your possible gains for that option that you sold, say you sell the option for $1, which is equivalent to $100 because it's 100 shares. So then your gain maximum is $100 minus your commission. So really the only time that you would potentially look at selling an option, in my opinion, personally, for risk management, is only as a spread or never a credit towards you, like a credit spread or credit butterfly or all of that. It would be simply to protect yourself for premium decay.
So don't mess with the credit spreads.
Credit spreads, you could really get yourself in trouble because you could end up owing your broker money.
Okay.
Just like if you had potentially done a credit spread on AMD and it went the opposite direction that you were thinking, you had puts, you could have really been hurt. Right?
All right, that sounds like owing a bookie up.
What'd you say, Cleveland?
That sounds like owing a bookie or something.
Yeah, exactly. You don't want to mess with it necessarily. We'll go over it more. All right, so looking at the options, right? Talking about decay, we have options for next week. And like we mentioned, we have the 125s here, and we have, what's the biggest one over here? Right here. The 115s and the 117s are really big for the volume for today. So you want to pay attention to that. If you're also looking at getting into something, look to see where the other volume is. Potentially there's people that know something about it and they're trading it accordingly. Maybe they are, buying the put here and selling this one so that their cost is 50 cents roughly. That would be a debit spread so that they're protecting the premium decay. Well, if it goes up, this one right here is going to become less expensive. Maybe it becomes 40 cents and they buy it back and they've ended up making 40 cents and they're happy. They'll give it the chance for the other one. We'll talk about it though. I think you, Kylie, you look a little confused. All right, so seeing the premium decay, right? You come back to today's, well, look, yeah, we still had big volume at 125, but what's it worth? 1 penny. Wah, wah. there's still a lot of activity that happened over here on the put side because it did drop down and people were likely trading these today. So it's not always that people are just buying or just selling. They could go in and out. It's the volume, much like a stock for the day. And this is something to remember. So the easier options to trade will likely be options $40 and less, and stocks that have weekly options, options that have penny spreads or a couple cents, right? If you get into it, you don't want it to be too far apart, and options that are caught off guard, right? We saw that, you guys saw that we had big, massive Apple prints. We know that a move is going to come. We don't know which way, but when you have 9 million, you know, it's something to pay attention to. We don't usually see 9 million shares traded on Apple in one day in the dark pool. And that will in turn also affect the S&P 500, the SPY options, and the Q options, Qs. So here's an example too of another one, like, excuse me, TDD. Here's our bid right here, right? These are our bids, and these are our asks. So what is the spread for a bid here and an ask here? So we have 2710, $2,700 minus 2340. We have 370 or $3.70, $370 spread. Until you really get into them, try not to get into the really crazy ones like this. Here's Bank of America, 35 cents, 36 cents, right? You could buy 20 of these and spend $700, and you're still only risking 20 bucks each way, right? Because if it's a penny, then it's $20 slippage getting in and out potentially of a trade, right? But if you'd had 10 of these, you're looking at $3,000 potential slippage getting in and out of a trade. Yeah, that's why it's good to practice. Try to practice on the easier ones till you get the hang of it. Because if you're going to be automatically getting in, if you were to buy on the offer and it starts dropping, then this could go even lower. This could go down to $19. Well, you got in at 27, you're getting out at 19. Ouch, $800 loss because you just want to get out quickly. So you really want to pay attention to that. That's going to be it for today, guys. So we will definitely cover the different strategies as well as the Greeks next time. So you'll be able to look at the chart. You'll be able to understand, hey, what is this? What's the delta? I'll put them all up here. Gamma. We have the IV, the rho, the theta, vega. Knowing what all of those are as well can help you at the same time to determine the best ones to get into, as well as looking at the volume and the open interest.
That is the one we need to be worried about, though, right?
You don't really need to worry about it so much. I really enjoy having the delta on here to see, hey, if I'm getting into something, if this is 170, you know, what will it take? How much of a move do I need before I gain 100%? If you look at Bank of America, all right, how much of a move do I need? Oh, okay, it's still up. So if you buy a 25.50, hey, this is 24 cents. It's 50 cents. No, it's $1.20 away, but this is 2 weeks away. So in 2 weeks, could this move $1.20? Pretty good likelihood of that. If it moved $1.20, guess what? I've made 100%. Lower risk, easy, right? It moves 60 cents, you make 50%. Might not be that glamorous, but remember, it's the base hits. Those small gains constantly getting your feet wet, and then slowly, when you have those small gains continually growing, you can become a bit more aggressive.
So that's your limit on options. You trying to get 100% or 20% or 30%? Like what are you trying to get?
It depends on, well, I'm looking more at the targets, aiming for the targets, not getting greedy. You know, constant growth is good. If you have, for example, if you had, oh, cancel, discard, hold on, I want to draw. Cancel, keep, discard. Let's go here. Let's just go to what slide has the most space? This one. So we'll go to this one and I'll pull it up. Or up here, it doesn't matter. So say you have 10 oh, sorry guys. So say we have, well, let me draw. Pen. There we go. Okay, so say we have 10 options that cost 20 cents, right? That's $200. So great. We now have the price up to 40 cents. We sell 5 options. We now have 200 risk and 200 in our pocket, right? Then it's a no loss trade, right? Well, you know what? Now it goes up to 60 cents. All right, I'm gonna sell another 3 here. Or we sell and we only have 2 left. So then we have 120 on the table and we have another 120 in our pocket. Well, now I set a stop on these back at 20 cents. No matter what, I've already made $320. No matter what, right? And if it's moving and you have the momentum, you could set the stop at 40 cents. Then no matter what, you make $400.
All right.
Right? So you've taken, or you actually make 200 no matter what. But if you look at it and you start breaking it down, do the mathematical of it. Try to see the way in which it makes sense for you that you want to stay in the trade. This, you never know. This could end up being $2.40, depending on how far it moves. And then guess what? You've now made 1,000% return. You started off with 20 cents. One that did that today was ACB. ACB went from $6 to $12, right? And so if you had bought an overnight, if you'd bought options yesterday for 10 cents, they would have been worth $5 today.
What was in ACB today?
ACB right now, it's at $9.79.
Wow.
But it went up to $12.16 today.
Yeah, we traded it. We day traded it.
Nice. Very nice. I didn't day trade that. What was I in today? I was in DRIP today. Well, let's see. I was in DRIP based on Biden. Get rid of this. Based on Biden, because he's talking about oil and fracking. And this one had a nice move today. Got in, let's see, put on 45-minute chart. Got in down here, just as it was breaking back above 67 something, and then got out at 71 up at the top once I saw it hitting the Camarillas and the pivots. This is my reason to get out, this orange line right here. So I got in once it broke right here and got out up here. So it's the constant small gains that will grow. All right. All right, guys, have an amazing weekend. Shoot me any questions. If there's any particular strategy you want me to cover that you guys are really curious about learning, just shoot it over to me. And I will also upload both the videos. I think I forgot to upload the other one. So I'll upload both the videos so you guys have that as well. And you guys can look at it over the weekend if you want.
All right, appreciate it.
All right, my pleasure. Have a great weekend, guys. Be safe.